Okay, folks, thanks for coming. Happy early 4th of July, by the way. I say that because a lot of VCs aren't in town. They take long vacations, but luckily we have a panel tonight, the VCs that are here.
We're all waiting for the healthcare bill to read over the holidays.
Yeah, for sure. And hopefully we'll have some fireworks tonight. So anyway, my name's Rob. I organize Idea to IPO. And there, hang on. How's that? Yeah. Let me borrow that mic. How's that? All right. So I organize Idea to IPO. We've been doing events in Silicon Valley for many years, and we have events multiple times a week from San Jose to San Francisco. We always have a busy, busy calendar of events. I'd like to highlight a few major events that are coming up. Thursday, July 13th, How to Pitch Your Wow to Investors, featuring Bill Reichart of Garage Technology Ventures at the College of San Mateo. In this room, Wednesday, July 19th, we have a panel discussion, latest innovations in fintech. Thursday, July 20th, a fireside chat with Vinod Khosla. That's in collaboration with the Commonwealth Club at the Palo Alto JCC. So check out all the details for all those events and all of our events on our website, ideatoipo.com. We were launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 50,000 members among all our meetup groups in the Bay Area. We've completed over 1,749 events. By any standard, by any measure, we're the most active, most prolific startup event organization in Silicon Valley, bar none. Is that all I got? Okay. So if we're the most active, most prolific startup event organization in Silicon Valley, and Silicon Valley is the center of innovation and entrepreneurship globally, that would make us the most active, most prolific startup event organization in the entire world. I'll take it. It's still a little weak. That's okay. Our mission is to promote entrepreneurship, support entrepreneurs, build community, and provide value in the Silicon Valley startup ecosystem. To that end, we provide content that is practical, actionable, and relevant, stuff that you can actually use to succeed as entrepreneurs. We believe in building community because Silicon Valley is an aspirational ecosystem, and it attracts people from all over the world who come here to do great things. And I'm always interested in knowing who here is not originally from Silicon Valley. Who here was born and raised in Silicon Valley? Just 5 of you? Okay. Well, welcome. So in addition to our content-oriented events throughout the week, we have social events. We have a regular TGIF, that's thank God it's Friday, Mixer, every few Fridays at the Hyatt Regency Santa Clara. And it's hosted by CJ Terrell, one of our team members. So I'd like to have CJ come up and say a few words about that. Let's hear it for CJ.
Hi everyone, I'm CJ. So as Rob mentioned, we have what we call TGIF Mixers. They're really cool ways to get in the community at the Hyatt Regency in Santa Clara, which is next to Levi's Stadium, for those of you who aren't familiar. And we do them every 2 to 3 weeks. We get a great crowd every time. And we get people really coming in from all over the world, from Asia, South Africa, actually last meetup, and some really other great countries. And our next one's going to be on July 7th. They are free events, and it's going to be from 8 to 11 p.m. I really do recommend coming out. It's a great area where we do it in the hotel. You can grab a drink, socialize, make new friends, and make new business, however you prefer. Again, on July 7th, 8 to 11 p.m., it'll be at the Hyatt Regency, and they are free. I do hope to see you there and enjoy tonight's event. Thanks.
With regard to value, it's important that we provide value at each and every one of our events. Not just value for your money, which is important though, because we know many entrepreneurs are struggling financially. So we make sure our events are affordable, and if you cannot afford the cover charge, come talk to me. We're always looking for volunteers and team members to help us out at the events. And team members can come for free, and there are lots of other benefits. And we try and have a decent buffet meal at each and every one of our events. Was this meal decent tonight?
Oh, yeah.
Oh, yeah. Well, let's hear it for Sherman Sterling for that decent meal. And no worries, it's back to Costco pizza next week for those of you that Costco pizza. And hopefully it's not your only meal for tonight, but if it is, please enjoy. But more importantly, we want to provide at each and every one of our events value for your time, which is your most valuable resource. Is anyone here getting any younger? I just have to check. In any case, when you invest your valuable time to come to our events, we want to make sure that you maximize your ROI. So we have many, many partners that help us do what we do. Law firms, venture capital firms, angel investor groups, incubators, accelerators, colleges, universities, lots of other players in Silicon Valley. So once again, we're grateful to Sherman and Sterling for hosting us at this beautiful venue and for the decent meal. Is this a beautiful venue? Okay. Let's hear it for Sherman and Sterling. A few of our other partners are here tonight. I'd like to have them come up and say a few quick words. First up, let's hear it for Chrissy and Quixie.
Hello, my name is Chrissy. I'm with Quixie. We're a mobile security app company. So we provide 21 layers of encryption on mobile apps, including Android and iOS. So if you're building a mobile app, come see me. We do a free vulnerability assessment, pen testing on your mobile app, as well as analytics. So we do IP protection, checking for unauthorized users, and also providing you with the best security for your mobile app. Thank you.
Next up, we have Brian from Cloud Brigade. Let's hear it for Brian.
Thank you, Rob. It's a pleasure to be here. Hi, everybody. I'm Brian Phelps. I'm a specialist with a company called Cloud Brigade. We're a managed services partner for Amazon Web Services. So we work with companies to help them optimize their performance, to make sure they're provisioning the right amount of resources. We can help you save some money. If you have any questions about your data center and how to migrate that over to the cloud, I'm happy to answer any questions. And I do provide a free 1-hour consultation and a TCO report for existing data centers. So thank you very much.
All right, next up we have Michelle from Robotics for Good.
Hi, I'm Michelle. I'm the founder of Robotics for Good, chatbots, messaging, and AI. It's a community on Facebook. You can just do a search on it, Robotics for Good, chatbots, messaging, and AI. So we talk about the latest news about AI and a lot of chatbots, consciousness, BCI, items. There are a lot of VCs in there, as well as entrepreneurs and bot makers. So please join. Thank you.
All right, next we have Ali and Planner.ai. Let's hear it for Ali.
Thank you. Thank you, Rob. My name is Ali, your chatbot superhero. By the way, I have to talk to you. So if you have any questions about chatbots, how you can use chatbots to augment inbound marketing, how to use chatbots to deliver a individualized, personalized content to your audience, how to use chatbots to automate workflows for your back offices, I'm your consultant. Come talk to me. Shoot me an email at ali@planner.ai. Thank you.
All right. So though our local mission is to help entrepreneurs here in Silicon Valley, our greater mission, though, is to democratize entrepreneurship and innovation all around the world. So to that end, we have a robust YouTube channel, youtube.com/idea-to-IPO. And we have tons of videos. We've documented and archived many of our events. And this rich, valuable content is available on demand, anytime, anywhere, totally free of charge, whether you're in Menlo Park, Palo Alto, Maui, Moscow, or Timbuktu. So our partner in this endeavor is Tim Jeggers of Jeggers Films, one of the top professional videographers in all of Silicon Valley. So let's hear it for Tim. I'll mention the Q&A.
Okay. Thank you, Rob. Thank you for having us, everybody. So yeah, I'm Tim. I've been doing the video for Idea to IPO for like a year and a half now. Before that, I shot weddings. I still do. I do like interviews, testimonial, informational pieces, drone footage, pretty much a little bit of everything at this point I've kind of gotten involved with regarding video. I do photography as well, headshots, studio stuff, and yeah, just anything multimedia I'm very interested in. So if you're like-minded or had any questions about anything that I'm doing, feel free to ask. I will be around. Thanks for having us.
All right, well, here's the schedule for the rest of the evening. So we're going to go into our panel discussion. Hold your questions. Panel discussion will probably run about 30 minutes. After that, we're going to have a robust, interactive Q&A session. So we want to take as many questions as possible. So come up to the lectern, use the mic, and we want to make sure we have a clean audio on our video as a learning resource. And we'll go all the way till 8:30. At that point, we'll break, and we'll have some networking until about 9 o'clock. As a courtesy to our hosts, we'd like to leave the building by 9 o'clock. I know some of you would like to continue networking. I think there's an after party at somebody's house. I'm just not sure what the address is. But actually, there's a round table down the street that stays open late, so we can always migrate down there if you want to keep on networking after 9 o'clock. So that being said, I'm going to pass it off to our distinguished moderator. He's one of the top corporate and startup attorneys in Silicon Valley. He's a partner here at this great firm. And he'll take it from here. So let's give it up for Chris Forrester.
Okay, thanks, Rob. Good evening, everybody. I'm Chris Forrester. I'm a partner with Sherman & Sterling. I work with companies from all stages, from inception all the way through their public offerings and their liquidity events in mergers, acquisitions, etc. Tonight's topic is choosing a venture investor for long term, and I'm privileged to have 3 VCs with me here. We're going to answer all of your questions, I think. But before we do that, let's take a few minutes to get to know the audience. So we can find out who's here. You can maybe tell us how many of you, by show of hands, are with a company looking for venture funding right now. That's probably a majority, maybe, simple majority. How many of you are investors? Okay, a couple of investors in the room.
Looking for funding.
You have to admit if you're an investor. How many of you are service providers? Okay. And we had a question from the audience. How many of you are startup event junkies? Come on, everybody should raise their hand for this one. Let's meet our panel. Shwank, do you want to spend a few minutes introducing yourself?
Sure. My name is Shwark Satyavolu. I'm a general partner at Trinity Ventures. Trinity Ventures is an early stage firm. I think this is the one that doesn't work, unfortunately. No, I think he swapped that. I can just use yours if that's okay.
Yeah, go ahead. Yes, sir.
All right. Is this any better?
Yes.
All right. So my name is Shwark Satyavolu. I'm a general partner at Trinity Ventures. We are an early stage venture firm, primarily invest in Series A's and Series B's. We're a $400 million fund, been around for 30 years. Our fundamental focus is software investing. So we tend to invest most of our things in a variety of areas of software. My specific areas of interest are fintech, security, and enterprise ML.
I'm Evangelos Simoudis. I'm co-founder and managing director of Synapse Partners. I've been in the Valley for closing on 30 years now. Initially as an entrepreneur, and the past 17 years as a venture investor. Synapse invests in early stage companies developing big data, both horizontal and vertical, big data and AI applications, which actually we're 2 partners. Both of our backgrounds is in that area, so we've been investing in what we know.
Cool. Is that working okay? Good.
Turn it on.
It's on. It's on. It was on. It's on.
Yeah, go ahead, Todd.
Okay. All right. I'm Steve Goldberg. I'm an operating partner at Venrock, which is probably coming up on 50 years old, was the original family office of the Rockefeller family, which is now, in 2009, we became an independent firm.
We don't hear anything back here.
Okay.
Yeah, just hold the mic.
I don't. It was working a second ago, and then it. Now we're good. Okay. We'll just do that. So, anyway, I'm Steve Goldberg with Venrock, a 50-year-old firm, originally came out of the Rockefeller family investment structure. We're an independent company now. We've got the 99-year lease on the name, and there's still LPs in the fund. But we do a little bit of everything. A few $1 billion under management, everything from healthcare to enterprise security, consumer, and anything else. Probably about 50% of what we do is healthcare, though. We're a bit unique in that way. I'm the science guy, so we don't do much in semiconductor space. I kind of sort of finished up with those deals, but I've done the semiconductor and wireless and networking stuff, and now I've kind of moved more into the robotics and drones, machine learning, and all the math stuff, because I'm the math guy. So anyway, that's I guess what I would say. The thing about Venrock is we're open to anything. I mean, it's one of these things we don't really have a specialty. Very wide range of expertise in the firm, and I look forward to hearing your questions.
Okay, well, before we get started, let me make a few observations, since at least the majority of you are looking for money. I've helped a lot of companies in their efforts to look for money. It's not an easy process. It requires persistence, patience, and endurance. You will need to meet a lot of people. You'll pitch yourself, you'll interview them. Some of those meetings will go well, some of them won't. On balance, you may end up meeting dozens of people. You may get very lucky, and you may find a great partner right away. Or, as I tell some of my clients, and I brought it along tonight, you may need to be prepared for the long road, and it may be a tough project for you. So with that, let's go through some questions for the panel on how you look for financing and some of the aspects of it. Do you want to maybe start by talking to us about what are the different kinds of investors? We have angel investors, we have strategic investors, we have venture capitalists, we have corporate venture capitalists, private equity funds. Maybe we could talk for a few minutes for the audience about the differences between these and your observations on it.
Sure. I think in terms of investor types, there's, I think, the couple of different axes. I think one is the stage of the investor, in terms of what stage of the company is and what kind of investors invest at that stage. And the second, I think, is kind of like motivation of why they're investing money. And if you think about the stage, there's definitely, the formation stage, which is typically mostly served by the angels, if you may, where they're actually putting money in to get something off the ground. And by the way, a lot of this stuff varies. If you asked me the same question about 8 to 9 years ago, I'd give you a completely different answer than what I'm giving you today. But as of today, I think there's now angels, there's pre-seeds, there's seed funds, then there is basically Series A, Series B, and C, D, and so on and so forth. And every investor that you go to will tell you exactly what their sweet spot is, and that spot basically has to do with what part of the startup life cycle they invest in. Angels are typically individuals. Pre-seed and seed are typically funds, which basically means there's a partner that's actually investing in somebody else's money in most cases. Series A funds and Series B funds are also the same kind, but they're actually typically larger, and so on and so forth. And as you go farther and farther, the funds get larger, the firms get larger, but they're also looking for a very different stage company at every point. So if you go talk to a Series A firm, when you're forming the company, you're wasting your time, right? Sorry.
Please.
And then the other axis is, I think, the motivations. So you can actually have financial investors or institutional investors that are basically investing primarily for financial outcomes. They're making sure that they actually make money off these things. There are strategic investors that are typically doing it for reasons that are not necessarily financials. They may not actually necessarily care about making money, but they may do it because they want to get leverage in a potential acquisition scenario, or just to get to know something about the space.
So, to add to Schwartz's comments, that I think one of the early decisions that you need to make, particularly for earlier stage companies, is which will also define what type of investor you want to work with initially, is what kind of help you need, right? So if you look at the gradations of angel investors, so within angels we have organized angel groups, so like Sandhill Angels here in the Bay Area, and that are teams of individuals who make investments under a single term sheet, right? And typically one or two of them will become more involved with the company. You have individuals who make investments under very loose terms, right? Very early on in the company, and in fact, when I did my first startup back in the early 90s, angel investors used to write relatively small checks. Today, there are angels that can write $1 million checks, right? And what characterizes them as angels is the fact that they're working on their own, right? They are willing to make these investments, as I said, under looser terms than an institutional investor or an angel group. The other point that I will make is that corporate investors have, over the past 5 years, have become extremely important in the funding spectrum. Just to give you some number, is that back in the mid-2000s, when we had a trough in terms of corporate investment in startups represented somewhere around 5% of the total investments made to startups. Last year was close to 30%.
Yeah.
And now, I think you need to, in all of this, you need to determine, as I said, what type of investor you want and why. Right? So if you were to approach a corporation and the venture arm of a corporation, you better have a very good idea of why you're approaching them and what you expect them to provide for you other than money. Because if you don't have a very well-formed idea about the type of investor that you want, then you have to wear Steve's hat and be prepared for a very, very, very long road.
All right. Well, these guys did great. Let me do a little fill-in for you. So this is my from behind the curtain view of things, not just from Venrock, but just in general, having been an entrepreneur a few times. The first thing is, I think the venture community, this is my opinion, but I think the venture community and investment community in general just does the absolute worst job of marketing what they do. Now, keep in mind, we're bankers. I've been doing this 8 years now. I'm still embarrassed to say it. I'm a banker. I don't know why I'm embarrassed, but I am. Because I'm a longtime techie and I switched hats. And the net is, they're not marketing people in general. I'm not going to point any fingers or anything. Some people are better than others, but the industry as a whole is not set up to market their wares and tell you exactly what they need. That's one thing for sure. It's not because they don't want to do it, by the way. That was one of the points I wanted to make. It's not because it's a secret on what Venrock wants and what our rules are and what our decision guidelines are. They are not a secret. We'll tell you. That's why you come to these kinds of events. We will tell you. You will answer any question you want to ask. The other thing is, and this is the point about Schwark was saying about every time we get asked a question 3 months apart, we get different answers, is that keep in mind what the goal is. In my humble opinion, there's only one dimension, I won't speak for angel investors, but I'll just speak for the professional investors like the VCs that I work for and others on Sand Hill Road, is that there's only one number that matters, and that's fund return. It's either cash on cash return or IRR or something. But it's just one number. Now, we kind of have to follow the law, and we generally don't invest in pornography and firearms and drugs and whatever. There's some certain rules over here. But otherwise, we want to make money. And so it's sort of counterproductive to go out there and say, we're not going to do, one person that just came out of a garage. Because if that one person happened to be Steve Jobs, Venrock wrote one of the I wasn't there then, but Venrock wrote one of the very first checks to Apple. And that was then, not now. But the point I wanted to make is, somebody walking in off the street just came up with an idea last week. Depending on the person and depending on the idea, we're going to do the deal. So telling everybody that we only do Series A's and Series B's, so what we say is we do mostly Series A's and Series B's. But the reality is, for the right entrepreneurs, and some of us, and most of those, I'll be very candid, are serial entrepreneurs that have very proven track records. And maybe, when Tony Fadell from Nest came to Venrock, it wasn't an early stage thing. We did that deal, but he had 80 of his best friends from Apple, and he was already at a $170 million run rate. We didn't ask too many questions. We just said, how much can we put in? I mean, you just did. And it was a big gamble because the pre-money was the biggest pre-money we'd ever had in the history of Venrock, and we lucked out and we made a few bucks. Pretty late stage, so we didn't make that much of a multiple. But anyway, to sum up, the point I wanted to make is just keep in mind and I don't want to say what you're up against because it's not a war, but in terms of being uncomfortable with what does it take to raise money, it's a moving target. Keep in mind that, at least for professional investors, what we're not measured on much more than return. I mean, as opposed to your mother, your father, your aunt, your uncle, your friends, your college friends, whatever, give you the money because they love you. And then I break it up, and I'll slice it differently. There's that group, which we all know, and we hope to death we're going to give them their money back plus some extra. Then there's the angel investors and sort of the middle folks who, the ones that have been through it for a while recognize that most companies, they're not going to be able to fund to fruition, right, to some sort of an exit. So if they're not aware of what our model is, they're probably not going to be successful. So the idea of thinking, I'll go to angel investors or seed funds because they're going to be easier to get money from. My opinion is, from my own personal experience, is that that's not really true, because the sophisticated investors that you want, the ones that are going to do a good job for you, they're talking to us all the time, saying, what is it we need? And they go out and look. It's a slightly different dimension. So once you're past your friends and family, I think it's pretty important that you recognize that the story has to be pretty solid across the board, almost no matter what level of professional investor you go after.
Thanks, Steve. Let's move to the next topic. What's the best way of identifying and reaching investors that are right for your company? There are a lot of investors in the community. We just talked about different kinds. How do you go about finding them? Do you utilize services of a finder, a person who says they can make introductions? Do you hire an investment banker? Do you just go knock on doors? Dan, tell us, you want to give us a start off on this, please?
So for me, the best way, well, again, it depends on the stage of the company. In an early stage company, when I see intermediaries, I typically believe that there is something wrong. Because an early stage company, for one thing, should not be spending money to hire intermediaries for fundraising. That's my belief. But typically, my advice to entrepreneurs is always understand why you are approaching a particular investor. In other words, do your homework and make sure that both the firm that you're approaching at a first level, but also more importantly, the partner that you will be approaching in that firm is, invests and understands the area that you're trying to work on or that you're working on. And then obviously with regards to institutional investors, as is the ones you have on this table, the best way is an introduction from a trusted source, whether it is somebody that we know or somebody that we have worked with before.
Chris,
Yeah, the trusted source. Okay, let's say somebody we have worked with before. Anyway, so those will be quick pointers.
Okay. Schwartz, you want to talk to us? How do you prepare for your meeting with your prospective investor?
I think the first thing is to make sure that there's alignment of what the investor likes to invest in, what they know about, and what you do as a company. Oftentimes, a lot of people will just go out and take every investor meeting that they can get, and they go out and try to pitch them. A lot of those things will be a significant waste of time on both sides. So I think the best way to do is to actually just understand a little bit more about what that particular investor is. Biases are. So what kinds of areas do they invest in? What are their theses in those areas? Nowadays, most investors, unlike back when I was raising money 20 years ago, you actually know exactly what they think because you can watch their Twitter feed, you can watch their blogs. Yeah, most people are actually pretty vocal about exactly what their beliefs are. And so you have a pretty good sense of what their biases are, what the kinds of things that they believe in, what are the kinds of things that they're skeptical about. And making sure that you actually understand that and then craft your story to that investor appropriately, right? So you have a core story that I think is going to be important. I think Sequoia and others actually put out this template of a pitch deck, I think, a long time ago. I think those things are much less important in my mind than actually making sure you're actually understanding who you're talking to and tailoring your pitch and making sure you're actually addressing their key questions in those spaces, right? And then be open about making sure you actually let them ask the questions to kind of get to the points that they are most interested in. The last thing you want to do is drone on for 20 minutes about something that investor potentially is completely uninterested in. And you've basically then lost half your meeting without actually trying to be able to convince them of what you need.
So that raises a good question. Steve, I'm coming to your office next week with my startup client. They're preparing materials. How much time are you going to give us, and what do you want to hear? What do you want to hear from us first and foremost?
So I'm just going to sort of add on here what I want to hear. I think with high probability, the investor that actually ultimately gives you money is someone who's made investments in a similar space before. So they kind of see you coming. So one of the things that I think a lot of, and this is directly related to the question, what a lot of entrepreneurs, when they make a mistake, is they come in and they do the pitch sort of flat, as if it was an uninformed audience. You have to just assume that if this is the winner, if the person you're pitching is actually going to give you money, someone who knows your space relatively well, and you kind of need to know what I'm going to say it I don't know how to say this plural, but the elephants in the room, you need to know in that particular space, what are the gotchas? Because my opinion is most VCs, they're just trying to decide whether to lean forward or lean back when you're running when you come into the room. And one of the ways we do that is we only get to date you 5 or 6 times. It's not like personal relationships where you might go out 50 or 100 times over a year or two. We're going to meet you and your team if we don't know you before 5 or 6 times. On the phone once, email once, initial meeting, another partner comes in, you do some diligence, full partner meeting, then some negotiation. 5 or 6 times. That's it. So you need to really take those times to make sure that you get your story across. So I'll just sum up what should you do in the first meeting. One is know what the gotchas are, because that's what we're going to be listening for. Automotive industry, wow, old industry, really hard to get into. Healthcare, highly regulated. Consumer play, how are you going to get to market? And enterprise play, cost of acquisition, customer acquisition, long-term value, whatever it is, know what the hot spots are and go right for that, because we're going to be waiting for that. And the other thing is, I think this is all kind of the personality thing. We want to get to know you, but make sure that you know your stuff. I mean, one of the other at Venrock, we're very financially driven. So even though it's an early stage firm and we're looking for ideas and you don't have revenue yet, but when you do we're going to write you big checks. And when you present your pro forma financials, if we ask you, what's in that cell right there? Why is the sales expense so high in the 3rd year? I hate to say this, but you get one shot at that. if you fumble and say, well, somebody else made that for me, I don't really know, you're done. It's not quite that bad. I mean, it's not like we hit the button and you fall in the water. but I mean, what I'm trying to say is, you really own what you're coming in with. And I think it's real short. It's not so much about the slide deck, is that you know your stuff.
And today, there is enough transparency, not only from the investor, there's a lot, but there's also a lot of information about current teams and alumni teams that this investor in the particular partner has funded, right? You can find this information. So again, part of your homework, make sure that you gather this kind of information, maybe even talk to these people so that you can understand how a particular partner team and a particular partner think about a space, kind of to Steve's point.
Thank you, gentlemen. So let's say that the initial meeting went well, and the fund has asked you to come back and talk with them some more. You're starting to look around the market and try to do your diligence on the fund. What kind of questions would you suggest as an entrepreneur that you be looking at? What diligence about the fund would you be thinking about? Maybe Evangelist starts off on this one.
So the first question I've learned as an entrepreneur to ask is, what is the stage of the fund? In other words, is the fund still investing, or is it at the harvesting period? As you probably know, all of these institutional funds have a 4 or 5 year investing period and a similar amount of time for harvesting their follow-on investments and harvesting their investments through exits. So even if you find the perfect match between the interests of a particular partner and the subject matter in your company, in your idea, make sure that the fund invests, has money to invest. The second thing is to really understand the strategy of the investor, right? Does the investor have the appetite to stay with you for the duration, kind of like till exit? How do they perceive exits? I mean, we've had situations where an investor came in and they thought that the company is going to exit in the next 4 or 5 years, and when the entrepreneur started talking about longer term plans because he had a particular bigger vision, and obviously in this case we didn't have there wasn't very good diligence being done from both parties. But again, make sure these points align because the due diligence process is like dating, but once you do the investment, it's like marriage, which is till death do us part, or hopefully a good exit. But you have to really understand, and good investors do. They think about, am I excited enough about this team, about this idea, about this company, to go all the way with them, and you need to be thinking the same way. Can I live with this investor for the next, if you're an early stage company, 7-10 years, right? I mean, because that's how long it takes for, particularly in certain spaces, for companies to mature to an exit. I'll stop here.
Well, I'll just add one more. I mean, I think the current numbers are it's like 4 to 6 years to M&A and 8 to 10 years for an IPO. Still averages. I mean, those numbers are still relevant, so it's a long time.
Yeah, it's a long time.
I just had one little thing. Just like job interviews, you can ask for references. And so absolutely, positively, you want to talk to the CEOs that this investor has worked with in the past. I mean, I would say it's a must-do. When you start getting close and you think you're going to have an option here and it looks like you're going to get an offer of funding, you definitely want to check to see how they behaved in the boardroom.
Sure. Do you have any specific questions you would ask CEO of another company?
So in terms of the reference calls?
Yeah.
I think there are a couple of different things, and I can speak from my experience as an entrepreneur here as well. one of the things that's going to be very important when you're working with a board member is you're actually ideally want to have a relationship of open communication and trust. There are board members you can get that you have to manage, and I know CEOs that actually feel like they have to manage their board, and there are CEO and investor relationships that are more of the advisor-mentor type relationships. And I think it's important to kind of find the right kind of person that can help you with the kinds of things that you need most. There are folks that have actually done this a couple of times. They don't actually need a whole lot of mentorship, so I think that's less important or less valuable. If you're starting out for the first time, you probably do need a lot more guidance, and actually knowing that is very important. So understanding how they deal with the CEO in a board meeting or not, and more importantly outside of board meetings, I think is important. The second thing I think is worth asking is to ask about a difficult time in the company's life cycle where this board member actually worked with that CEO. The one thing that is almost definite that will happen in your company's life cycle is shit will happen. The question is, what happens when that happens, right? Like, what is the relationship between the CEO and the board when that happens is very important. And a really strong CEO-board relationship, so actually we'll get through that just fine, actually get to great exits. And dysfunctional board-CEO relationships will actually end up killing companies. So I think it's very, very important to make sure you're picking someone that has the right chemistry and the right level of complementarity, if you may, or help that you need.
Chris, I'd like to add one more point, if I could. I think it's also in the pre-investment process. It's important to ask and understand what is that process that the firm follows. Different firms, I mean, at a high enough abstraction level, we all do the same thing, right? But every firm, because of the personalities of its partners, the norms that have been established in the firm, particularly for firms that have been around for a while, they have norms. They have established processes like any company does, right? Or hopefully it does. So you need to understand that process, and you need to make sure that you're providing the right information, you have the right expectations as you're going down that process, because it will help you decide who to bring into meetings, right, with from your team and your other colleagues, whether to bring, for example, an advisor to a meeting to help you and to get to know any of your prospective investors. So understand the process as well as everything else that was mentioned.
I'll just add, as a lawyer and having seen a lot of these situations, I think it is important, super important, to understand how things happen when things don't go well, how do the funds act in a down round, how do they treat the founders. A couple other things that I think my clients, we tell them to ask, is what are the other venture funds that the funds will partner with? Your lead investor may frequently have other funds that they'll want to partner with down the road in successive rounds, and it's worthwhile to ask who that might be if they have preferences, and then do the diligence on those funds as well, because you may think you're going in with a lead horse, it may actually be a couple of them. And then in a similar vein, I find it's also important not only to get to know extremely well the lead partner at the fund that's going to be managing your investment, but also the other people on the team. Things in life happen, people retire, people die, people change careers. You may find yourself going in with Schwark and ending up with Evangelos and deciding that he's not really the guy that you wanted, or maybe he's even better. You never know. No offense. So just some other diligence questions that you... So we only have a couple more minutes. I want to just cover one more topic, and then I know there are probably a lot of questions. So let's talk about how do you found an investor, they found you, you've been dating 5 or 6 times. It's enough for a shotgun marriage. What do you do next? How do you start the process of negotiating the term sheet? And some questions I'll throw out for the group, and you guys can answer them. Do you as the company want to propose the first term sheet? Do you want the investor to propose the first term sheet? When should you get your advisors, like your counsel, involved in that process? And then I'm going to end with the last question, which is the size of the pie question, is do you take more money than you think your business plan calls for, and what are the pros and cons of that? So maybe start at the end. Steve, you want to talk to us about the term sheet and that process?
So, again, I'll just sort of speak for this Series A, Series B kind of firm that I work for. And it's not like Shark Tank. You don't come in and say, I'll sell you. There are a few entrepreneurs in the Valley that can do it, but most of us mere mortals, as an entrepreneur myself, my sense is you don't do that. You basically tell your story. I suppose like it's done in the public markets where there's signaling kinds of things where you signal you're looking north of a certain number, or maybe that happens. But I would say in general, you give it your best shot. And this is one of those things is how do you know when you got a bite? If any of you grew up fishing and you put the bobber, on your fishing line and you're watching to see if you got a bite, that's a whole nother longer conversation about when do you have a bite. But if you do, my sense is from our firm, it's kind of a bimodal thing. There's companies that come in, and it doesn't matter what sector or whatever, there's companies that come in where we just know, oh my gosh, this is something we've been looking for, it's a good team, we really want to do something. Plus we get signaling through the network that from our other colleagues that we do deals with, that, hey, did you see that? Did you see those guys? Would you like to do that together? So there's some backdoor stuff going on. So those companies get funded relatively quickly. It happens, you have your last meeting, and the next day or the next couple of days, it takes us an hour to do a term sheet. I mean, this is not a long process. And then there's the bimodal thing on the other side. If you're not ready, if you don't have references ready, if the customers really aren't ready to talk yet, and again, Series A threshold varies, but then there's this, bump out a few months because we have to sort of really dig in and try to figure it out because we're interested, and then there's a long tail all the way out to just don't get funded. But I would say that you kind of, in general, at our kinds of firms, you don't really go first. And it doesn't really matter because at that point, once a number is thrown out, you can either look at other deals that you got from other firms or you can counter and you can have the conversation. But it usually comes from us first.
I agree with that. The only point I would add is it's actually appreciated, nothing more than that. If you know that you have a strong affinity for a firm because your diligence showed that, and from these few interactions that you've had, you show that you're quote unquote hitting it off. It's okay to indicate that to the firm, right? I mean, you're not losing anything, you're not giving anything up. But I agree with Steve. I would never go in and say, here's our term sheet. Are you on board with that? And let alone signaling valuation expectations or whatever else. I mean, let VCs do their job from that perspective. But I think if you really like to work with a particular firm and with a particular partner, indicating that is important.
Yeah, I think I'll answer one of the other questions around how much you should raise, which is actually somewhat related to the terms question a little bit as well. I think when a company comes in, depending on the stage, if you're raising a Series A or Series B, what you raise kind of determines a lot of the stuff around the key terms, right? So if you're going to raise $10 million, you're going to raise $6 million. Because ultimately, if you go to a Series A investor, they're looking for 20 to 25% of the company at that particular round in terms of their ownership. If you go to a Series B investor, they're looking for somewhere in the 10, 15, 20% range, depending on where the stage of the company is. So there is a certain kind of band, if you may, in terms of ownership that the venture firm is going to be looking for. And if you're going to raise $10 million and your existing investor has $3 million of pro rata, which basically means the new investor is $7 million, you basically are kind of indicating roughly the kind of brackets of where this round's going to come together. Now, the investor always has the choice to come back and say, I'm not going to give you $7 million, I'm going to give you $5 million. And that's a big discussion that can definitely happen and oftentimes does happen. So I think picking how much you raise and thinking very long and hard about it is very important. and being able to justify it. Like, if you just walk and say, I'm raising $15 million, and your business looks like it needs 4, then you lack credibility. But at the same time, it's completely all right to come back and say, look, I need 4 to get to whatever the next round's milestones, but I'm going to raise 6 or 7 because I want to create enough of a buffer here for things that might not work out and so on and so forth, and then say, that's why I'm raising 6 or 7. And that's fine. That's perfectly okay to say that, right? But have a very clear basis for what you're asking for, and do raise more than you can. In fact, I would tell you raise as much as you can, and I always tell entrepreneurs to raise when they can rather than when they need to. You don't ever want to raise when you need to. You always want to raise when you can.
And you always want to assume, specifically for early stage companies, that 20 to 30% of the round will be, I won't call it wasted, but you will not have a direct result from that. It happens in every early stage company. You may do a pivot, things may take longer than anticipated because you don't have the references yet, because your product doesn't have all the features. So, and this is something that, at least experienced investors understand. So that's again, going with Shark's brackets analogy. That's how I would be bracketing the amounts that you're looking to raise for the round that you're looking to raise it at.
Thank you. I find that's always an important question. Well, let's move to questions from the audience.
First of all, let's hear it for a panel on the research. So we'd like to take as many questions as possible, so kindly come up here, line up. We want to use the microphone so that way we have clean audio, and it'll be helpful for us to create a great learning resource. So step right up and go for it.
Hi, a friend of mine who's a serial entrepreneur said to me, Dwayne, I've spent wasted a decade of my life looking for capital. I looked everywhere, searched, put thousands of hours into it, never found anybody. And then he had to sell out his company to LSI for $58 million because he had to sell out. I spent 18 years of my life trying to find capital, and then with the one exception of a contract for $60 million that was signed, and they had the money, and then that very same week, the stock market crashed in 2008, and the contract became worthless. I could tear it up. So I had the $60 million that I could just tear up. Prior to 2008, I could file cabinets so people interested. After 2008, silence. Dead silence. And so there's thousands of people out there looking for money, perhaps millions. Show me the money. I don't believe it exists. I see nobody that's getting funded. I don't know one single investor anywhere that I know personally that's been invested. I hear a lot of talk. I don't believe there's money. Show me the money. I hear talk about money, but I don't see any. So I don't think it exists.
Well, I won't directly respond, but I can give you some perspective, okay? So, again, the Series A, Series B, there's a couple of e-letters that you can get. One's called term sheet, and what's the other one?
I've got it.
Yeah.
It doesn't work.
Yeah, no. All I'm trying to say is there are deals done every day, but here's, you want statistics, I can give you perspective. At Venrock, there's like 10 investing partners, and we do an average of 1 deal per partner per year. Okay, so in 50 years, it's 500 deals. Now, there are plenty of other firms, some of the bigger firms, Sequoia and EA, I don't know what Trinity does, but the net is, it's not a ridiculously high number. It's not zero. There are deals done every day, and all we do all day long, that is 99, besides going to board meetings, it's 99, and supporting the deals that we have, 99% of the job is to source new deals and go out and make deals happen. Otherwise, the LPs don't give us money. And like Evangelist said, we get a new fund every 3 or 4 years, 3, 4, 5 years, depending on the market. and then we spend about half of that in their 10-year fund, so they're overlapping. So as soon as we finish funding all the companies we think we can support with reserving follow-on investments, we raise another fund. If we don't deploy that money, the LPs go to another venture firm. We've got competitors too. So I would just say, again, not responding directly to what you said, but the money has to be spent. So when you hear that there's umpteen $1 billion of venture capital being put into the market, I can guarantee you that money's, now it's not called until it's ready, but it gets spent.
I'll just respond empirically to you because I just happened to look at this yesterday. The NVCA puts out a survey, and they publish it quarterly. So there were 1,808 deals done in the first quarter of the year, which is down from last year, but it didn't fall off a cliff. So
you mean the Valley?
Since 2008.
That's
That's a national.
in the U.S.
That's in the U.S. No, that's in the first quarter.
No, first quarter of 2017.
Correct.
Is that VC level, or is there an over and under threshold for dollar amounts?
No, that's just reported deals.
When they say
NVCA.
Yeah, you'd have to look at the exact
NVCA reports deals from its member firms.
Institutional.
And so this tends to be institutional VCs. I would say on an average year, there's about $50 to $60 billion that is deployed by venture capital. Okay, so
where's that figure from?
this is NVCA,
National Venture Capital Association. You can go to their website; they'll give you statistics. Yeah.
Anyway, next question.
By the way, I forgot to mention, no thinly disguised pitches. Not that anyone would want to try it. Sound pitching that.
Next.
Okay, because Rob knows that, I mean, part of getting funded is that you walk and talk. You can't be humble. You can't bury your thing. That's why I always carry my light with me. Kind of two sides to where I'm coming from, and one of them involved today in a serious long-term situation. 3 years ago, I was significantly invested in by one of the well-known angel funds. Since that time, we have product, patent, some profit, people, moving along to where now I've learned by being yelled at, hey, you're ready for your next round. And there's nothing wrong with saying the angel round worked, but now it's next step. Let's turn this into a more business operation than a more individually driven situation. So that's where I'm at, is shopping for the next round. But what came up today, because part of shopping for next round is you show your accomplishments. One way of getting out of speculative situations is to show hard design and license contracts instead of saying someone's talking. So, question specifically, you can tell me, I'm at a walk or no walk with one of the very well-known major flashlight and bike light companies in the world. I thought we had all the details worked out for design and license deal for what will be targeted as 50,000 sales just through them within the next 3 years in the electric bicycle market, with a street legal German and European compliant beam that exceeds anything anyone else has developed. Well, today we're going through final contract language, talking on the phone, and then he says to me, after X so many amounts of units, we want to cut the royalty in half. No time frame, no yearly units. Do I just say, okay, no thank you, this doesn't work for me? Or do I cave in? What's the value of having this licensing deal in place for a known future revenue up for maybe the next 5 to 8 years versus walking from what otherwise could be a bad deal?
Sounds to me that you need a board of directors.
We're keeping it as an LLC to be flexible so we can reform under our next round.
So actually, this is a very good example of help that a group of experienced investors, venture investors sitting on a board of a startup can help the CEO with. I don't think we can give you an answer here to your question, but again, what I think you and the audience could take away from your question and the situation we described is that there is a lot of value in having such a board, even at an early stage of a company, and selecting very carefully
who you're going to put on your board, because it's not only the money that you take and the halo effect that the firm that gives you that money will have and provide to your company, but really, do you have the right experience around the table by the board members, by the investors, by the partners who are going to be on your board to help you in situations like this?
So what kind of criteria should I be thinking about tonight to make my decision whether to go back to them in the morning and say, polite no thank you, or okay, let's do it?
I have a kind of a general answer that will cover your question and some others, and that is, you're asking it related to how would investors look at the kind of deals that you have going forward.
Yes.
Yeah,
in other words,
that's
stronger.
And so what I would tell you all is this, kind of related to what I said, something I said earlier, and that is, keep in mind what the motivation of the investor is. We want to get our money back and then some. In other words, we want to build a lot of value. I think what a lot of entrepreneurs forget when they're pitching, we're Series A, but we don't need revenue. What we need is a vision and some indication that that vision could come true of building a lot of value. So one of the things people do to just very pragmatically is people will say, we're in business XYZ and this is what we've done. And by the way, in the last 5 years, similar companies in this space have sold for X, Y, and Z. And so if there's any question that the investor doesn't realize that you can build a lot of value in the sector that you're in, you're showing them that. So again, I don't think we can answer your question directly, but what I can tell you is the decision you make about whether you take a deal or not and how many sales orders you bring in or whatever, we're going to look at it through the lens of how valuable can this company be in 3 years, 5 years, 7 years, and the bigger picture. Whether you've got one specific deal or not, I would say we play down, because as was said earlier, we're in this for a really long time, and I use the exact language Evangelos used. We're getting married. I mean, after we're in, it's very uncommon for institutional investors like you've got up here. Once we're in, through thick and thin, through whatever market variations, we're going to be in the next round. I mean, in 17 years I've been related to Venrock, I can only count a handful of deals, less than 5 for sure, probably less than 3, where we said, no thank you, we're not in the next round. I don't think anybody shot anyone, but it was probably like that. In other words, we're in. So I would just think about long-term vision, and again, you'll have to make the decision on this one on your own. We're not going to jinx it either way, but you got to think about what we're looking at long-term.
Cool. Thank you.
All right. I know there's a lot of founders here, and so what advice would you give to founders on what instrument to select when doing investments in the seed round, the choice between convertible note or safes?
So that's, I think you'll hear a variety of opinions on the topic because there's a very, very wide variety of thoughts on the topic. My take on it is that, if you're raising a round that is somewhat sizable, right, which is, call it $1 million, $2 million or so, I would actually think about pricing the round, because I think fundamentally the convertible note, that thing only creates a whole bunch of complications that get messier and messier depending on how the process evolves. There are these caps, there's all these things that convert. In fact, we look at deals all the time. Sometimes that whole construct actually turns people off, because there's a lot of money converting at that next round, and sometimes that complicates how much money the money the investor needs to put in to be the majority investor in the series, et cetera, et cetera. All kinds of things that can complicate the issue. So if you're raising small amounts of money, $100,000, $200,000, then I think it's less impactful, less valuable. But if you're raising non-trivial amounts of money, I think pricing it out is actually the best way to go. And that's my opinion. I will tell you there's probably going to be enough people that disagree with that point of view. Right?
But there's a fine point in the question of the safe versus a convertible note. Those are probably very different instruments legally, and so the good question perspective is important. If any of the three of them had said to me, hey, let's do a safe, I'd say, no, let's do a convertible note. If you're on the company side, you might find a safe might be a more interesting idea, although you might find that it is a convertible note if it's sort of open question. So.
Yeah, actually I was going to say the same thing. I try to run away from safe as much as I can. Sometimes you fall in love with the company, you fall in love with the team, and we have feelings too, regardless, despite what people think. But I would say, and again, this is not only for this initial stage. As an entrepreneur, I always used to think not only of the next round, but on the round after that. And I continue to give that advice to whoever wants to listen, because you need to make sure that however you structure your round, you don't overcomplicate what comes next, unless you believe that you will not ask for another round. And there are entrepreneurs who are very successful at that, right? They want some seed money to get going, and then they take care of the rest of it. Takes care of it by itself. But if you're thinking that you want to have a quote-unquote traditional venture-backed company, which means multiple financing rounds, even if everything goes up and to the right, okay, then you need to understand how this initial instrument, whether it is safe or whether it's a convertible note, how many investors get under this instrument will influence the follow-on rounds.
Just by show of hands, does everyone know what a safe is? Okay.
Right, thank you all for the terrific content, great advices. So my question is about a report about AI investments in 2016 that I had the privilege of reading a couple of days ago. I noticed that volume of funding in 2016 has been more for AI companies compared to 2015. However, the number of companies have reduced. So is it because the market is exhausted about AI, you guys don't like to invest in more AI companies, or these standards have become, more sophisticated? You'd like to see more checkboxes checked before you invest in an AI company. And second, about the likeliness of VCs investing in B2C AI companies as opposed to B2B ones. Thank you.
So I'll make two comments, and then like it happens in every subject when there is a perception that there is investor interest in the subject. We see the business plans that may have nothing to do with AI, using the words AI and machine learning, blah blah blah. And last year we probably saw about over 50 companies that do chatbots, and all of them had machine learning in the presentation. And I would say at least 50% of the people who came to at least took an email interaction didn't even know what machine learning really is and how it would be used in the product that they were proposing to build. So I think the investors that you will want to work with know their stuff pretty well, okay? So if you see, obviously there is momentum in certain sectors, cloud computing, big data, blah, blah, blah. But there is, don't think that just because you put some collection of keywords that you automatically get funded. So I think you're seeing a lot of that. You're seeing a lot more business plans, presentation, whatever, investment opportunities where there is the use of the word, but if you start peeling the onion, you don't even need to go 10 layers down. By the second layer, you realize that it's artificial, not intelligent.
I would also say, too, I think an embodied that answer is, I do a lot of IoT stuff, and I only use the word, I try not even to say it, because it's not really an investable space. I mean, it's healthcare and industrial and personal health, personal health and you know, hospital systems and automotive, whatever. So IoT doesn't mean anything, you know, in that sense. And I think the AI thing just got kind of overused and pent-up demand, whatever. So I think you just got to use your good judgment here that if you follow it, if you kind of do, you know, kind of understand the underlying science and technology there, is just recognize if it makes a difference in an industry, the investors are going to care. And if you can find a place where you can leverage it, and it's going to add value and build value, believe me, you'll get ears to listen to the story.
Yeah, I think the one thing I'll add is that there has been an explosion of seed funds. What that means is there's been an explosion of seed-funded companies, and all of those are coming up for their Series A's. And one of the things that is increasingly happening is the vast majority of those seed-funded companies are not going to raise their Series A. So, and what are most of these seed-funded companies doing, for the reasons that Evan talked about, is that the whole ecosystem is AI companies, blockchain companies. There's some 3 or 4 buzzwords. IoT. So there's like 3 or 4 kinds of things that every company is. And they're all seed funded. They come up for their A's, and right now the A's are being more selective. So the companies that are actually doing well of those seed funded companies are actually getting sky high valuations, because every investor is going after those companies. And the ones that aren't doing well aren't getting a second look. So
thank you so much.
Thank you. Thanks for your comments. Actually, I have multiple questions, so that's why I keep looking at my phone. One, you talked about lead investor and co-investor. Just want to get your thoughts on, if you do a lead investment, how do you perceive a co-investor being a corporate company? Because there are corporate organizations that don't want to go being a lead investor; they would rather do a co-investing. That's one. Then second thing, similar to an AI space, companies have invested a lot. But how do you see someone else that is having that technology or a game-changing technology in the AI space itself that's looking for funding? Then
what was that? So what's the
because
question?
If you've already invested in an existing company, that now if I'm going to come back and tell you I have this AI company that is looking for funding, it may compete with some of your portfolio companies. How do you see? Balance that out against your portfolio companies. Then the third thing is, how do you see companies that skip just do angel funding and are looking for Series A, late stage Series A, versus actually going through seed and rest of the other stages? We skipped all of those. We are now, if you are looking for only Series A, we have a lot of partners that are interested. How do you see some of that from your standpoint?
I think that's enough in terms of questions. Yeah,
we're going to charge you more if you're asking.
No, but we'll forget what you're asking.
Then one final question after you say, and I'll leave it.
I think you got to give a chance to some of the other folks.
Okay,
you asked 3 questions. That's pretty good.
Yeah.
Go ahead. You go first.
I think that having corporate investors as co-investors makes a lot of sense. In fact, there are very few corporations that have primarily funds that have financial goals as opposed to strategic goals that they will lead investments. So Intel Capital, for example, Sapphire Ventures, which are, even though they're associated with the corporation, they're much more like an institutional investor. So looking to supplement your investor syndicate with a corporate VC makes a lot of sense. But I think very much like we were saying before in terms of how to put together a syndicate of institutional VCs, you also have to think about what this corporation will bring to your syndicate and to the value of your company, right? You need to stop thinking. I mean, I'm not saying that you are thinking, but entrepreneurs should not be thinking
of, okay, I just need, say, $10 million, whoever raises their hand to contribute towards that $10 million there, I'll take. I mean, you really need to be much more deliberate, and particularly with corporations, that deliberate approach means a lot.
But I have a slightly contrarian viewpoint on it. I actually think that if you have financial corporate VCs, there are a bunch of them. I think Google and a bunch of others actually are, financial investors. There, I actually don't think it makes any difference. They're just like any other financial investor. But there's quite a few corporate investors that are actually, of those 30% of the deals, I don't think all of those are coming from the financial investors. But quite a bit of that is coming from the strategic investors. And there, I actually do think it's kind of complicated because one, you actually have investors that actually have very different, objectives, and so you're going to have a very crazy board situation when you actually have some folks that are looking for certain kinds of outcomes and others that are looking for other kinds of outcomes. And the second is that in almost all those cases, it actually has a detrimental effect, I think, on your exit options and exit values and so on and so forth, because there's an asymmetric level of visibility for one corporation against a bunch of others that could be potential acquirers and so on and so forth. So I would stay away from corporate VCs that are more strategic VCs whenever possible, if you have the choice. Some people don't have a choice. And in some cases, very selectively, like everyone was talking about, I do think if you have a very clear corporate need that you need for that corporate VC or that particular corporation to play in your company, then you can consider it. But I will warn you that corporate VC funds and the corporations themselves oftentimes are not very tightly linked together. So you're not actually going to get what you think you're going to get when you take their money. So in a lot of ways, I'm much more skeptical.
And let me just answer. I'll just go to the second question. Exactly what I said. So we don't invest in AI companies. We invest in a company that uses AI to make better hiring decisions. We invest in a company that uses AI to help drones, do collision avoidance or something, or help an automobile company do machine vision to avoid collisions. So we don't invest in a second company in the same space, but the underlying technology could be really similar, and that's just not an issue. The real issue is if you're competing for the same customers, we typically wouldn't do those. We wouldn't do both those investments. And I forgot the third question. So.
Well, that's good. Thank you.
Okay.
Thanks.
I guess we got it.
So we have about 11 minutes left, so we just ask you one question.
Hello, my name is Eugene. I have a startup, but also I'm earning money by doing marketing consulting, mostly for the companies which I'm going to Kickstarter. And I saw many stories behind that. Like, for instance, one of my current client, he's raising round B after successful Kickstarter. I made help the company which after seed investment, if you heard about Luxury, they were my clients in 2014. From seed investment, they were acquired by Snapchat for 150 million. So I made marketing for them. So I saw many stories behind that, but all of them are classic investment stories, like seed funds, seed funding, round A, round B, and so on. Last time I started to meet cases when teams, startups, they're telling, we decided to go to the ICO, means blockchain, cryptocurrencies, and so on. So, what do you guys thinking about this? Because this is something new on the market when startups are not going to the seed funding, to VC. They are trying to raise funds through cryptocurrencies, through ICO. And what is your relation? What is your opinion about all that? Because this is something which all of us will meet more and more last time.
At this point.
I can give just a quick answer, and
Okay.
these guys will be really give a better answer than I do. But what I would say is this: however you think it's best to fund your company, it's great. I mean, we're one option. Right? And we talked about all the different kinds of options. But one thing that you have to do keep in mind, we do have a model, and Schwartz haven't talked about this, we do have kind of models that we work with. And at each round we come in, we sort of have to have a certain amount of ownership. So depending on how the math works with the amount of money you're raising and what the last round valuation was, coming in from sort of the side angle that, it's the classic, I don't know, the classic, but companies every once in a while, maybe every few months, I'll have a company come in, it's got $20 million in revenue, has never raised any money from VCs, and wants us to make an investment. Well, if the expectation is, the company's worth 50 or 80 or $100 million, we can't write a big enough check to get enough ownership to matter. So other funding mechanisms sometimes take you out of the game if you want to come back full circle. I don't know.
Yeah, I think, clearly ICOs are all the rage right now. Apparently $600 million has been raised, 500 of which has been raised in the last year, this year, and of that 500 million, most of that has been raised in the last, 10 weeks. So it's a little bit of a free-for-all at this point. But I think the fundamental foundation behind that is simply kind of doing a very early IPO. It could be whatever, your own token, this, that, etc. Ultimately, it's the same kind of thing as doing your own IPO. And if you look at things like Indiegogo and Kickstarter, they were early versions of the same thing, right? In fact, they're actually somewhat equivalent. It's almost like a tradable Indiegogo token, sure, right? So that's really what all these ICOs are. And when you think about that basic model, you look at what's happening in Indiegogo, 30 to 40% of the stuff never ships. It's a lot of people actually lose their money. And there's a reason why, there's the SEC and that you just can't go public with nothing, no product, and so on.
I can tell you even more, because during the last 5 years, successful were like 30-40% of my clients, but delivered not more than 5
There you go. So it's maybe even worse, right?
So now the story's behind.
And so that's the issue, which is now you have people that are raising money that from individual investors at this point that may not ever see what they invested in. And so I kind of feel like if this rate keeps going, there's probably carnage to be seen. Mm-hmm. And to the extent that at 600 million, it's still not a whole lot of money. But if it goes at the same rate, the growth rate goes at the same rate, you could see the next mortgage crisis.
But do you feel this kind of bubble, or this is some new tendency?
I do think there's some inklings of an alternative way of arranging different kinds of contracts that comes out of this. Mm-hmm. I kind of feel like this is like the 1990s internet, where there was a substantial amount of euphoria, individual investors putting a shit ton of money, everybody lost their shirt on it, but we got the internet out of it, right? And we got a whole lot of good out of it that then we kind of reset our expectations and built from again. Mm-hmm. I kind of think we're in that phase of blockchain right now.
Okay. Thank you.
I'm Sumit, and thanks for your talk. Good question. So, what is the kind of advice that you give for the companies or entrepreneurs who are trying to operate on the traditional market, like events, local, and shopping, which was in a boom earlier, and they have already raised angel and seed. They have made a dent, but there is already a history attached to it, right? So, what's the advice, or what is the thing that you look when they come and pitch?
Performance.
So the performance was based on the seed round, or let's say they are able to make some dent, but
yeah, but especially because of the baggage that comes from all the prior investing and all the other learnings, the only way you can circumvent that is performance. If you can show that you have bucked the trend of why that's not an investable space anymore, then that's the only real route to make that an investable company.
So is it performance in terms of revenue, or acquiring more businesses, or acquiring more customers?
It depends on the specific elements of the things that are not working anymore in that space. It depends on the space and what about it. It didn't work the last time.
Thank you.
Thank you. This has really been a great panel. I go to a lot of these, and you guys are just great. You're giving lots of great free advice, so thank you. So my background is technology, and my co-founder, CTO, 10 years in machine learning and vision. And so wondering, we're now going out for our either seed or Series A. How important is it that the VC understand the technology we're building? For example, a lot of the things you said about deep learning, understanding how it works, et cetera, and how to apply it to a business, my preference is to go to somebody who actually understands the technology first, as well as the business.
Let me just give you some perspective. So that's a quick answer. I know I don't have much time. So you come in with your 15-slide deck. When you're pitching most VCs, you probably want one slide on technology. The rest of it should be about the business. You're building the business. If you've got experience, if you've got strong education, we're going to give you a checkbox on technology the first day just because somebody recommended, a trusted source recommended you. And then we're going to either, look, when you're talking about institutional investors that have raised multiple funds from limited partners over many years, which is kind of what we're talking about here. I can't really speak to sort of seed and angel investors that may be popping in and out, which isn't bad, but when you're talking about institutional investors, the firms aren't going to allow a partner to do a deal they don't understand. So I would just basically say, I wouldn't worry about it, because it would be a wonderful thing if somebody offered you a $5 or $10 million Series A and they really didn't understand what you're doing. It's very unusual. If it happened to you, okay, you were in the real minority. It's just not going to happen.
The point we were trying to make before, I think, is the fact that the partner who is going to be leading that investment needs to have a good appreciation of the problem you're trying to solve, of the approach that you're taking to solve that problem, right? And how well it matches with the firm's, investment philosophy and investment thesis. Okay? And most of the institutional VCs have enough resources to check every detail of your technology if it gets to that point.
Yeah, so I appreciate that. That's great. I'm really saying is it's very easy. I can explain our business in about 3 minutes, including with all the charts and the financials. But really, I think AI is fundamentally different from other technology I've worked on before, and the possibilities of what you can do with it is fundamentally different. And so having someone who is finishing your sentences on where you're going with the technology, I think is easier. And so I'm really looking to find companies where there are people in the firm who have already gone to that level and understand what you're trying to do with it.
Yeah, I think it relates to the problem, but yeah, I agree.
Well, and what I said earlier, I think, is actually true, that if you have, and I think it was said earlier, if you have that kind of relationship and one or more meetings with the partner, it's highly likely you're going to get funded. So in other words, if you're feeling that way, that they're finishing your sentences and they're feeling like you're finishing their sentences, you got a good thing.
That's great. Thank you. Thank you.
Hey, my name is Mike, and I was wondering if 80% of the startups fail, what are you guys doing to kind of minimize that? I mean, is that an accurate number for the companies you guys invested in? I mean,
well, I just read an article about that yesterday, and somebody probably saw it. So, just to be fair, so I know what Venrock's numbers are. We lose very few, right? It's a quite, you use a baseball analogy, hitting singles, doubles, or home runs. I mean, some firms are more interested in the home runs and will gamble a little bit, have more losses. I think that argument of 80% fail, correct me if I'm wrong, was 80% didn't return 1x capital or more. Okay. So 80% in the institutional capital, in the institutional VC world, we don't lose 80%. I can tell you that. if we lose, we do about, in a $500 million fund, we do like 30 plus or minus 5 companies. And if we lose 2 or 3, like within a year, that's about right. The rest of them, there's always some return. So saying 80% fail is probably not enough detail.
Thank you so much.
Hello everyone, and this is a wonderful event. I just have one question. How would a startup that is trying to change a behavior of people measure its pre-product release traction? And what would you as investors consider as traction before you reach out your wallet and say, okay, here's the money, you can go and test your product in the market?
Well, if you're talking about a pre-product, then again it would be based on the quality of the idea, the problem that you can, the difficulty of the problem that you're trying to solve, and both the case that you build in terms of the importance of this problem and to Steve's point, the returns that can result from the solution of that problem, but also from whether your statements, your suppositions align with what the investor may already know and believe about this problem, or they can identify in the process of doing diligence.
Thank you very much. You kind of answered my question. I sat down, but then I returned because it kind of bothered me, and I still wanted to ask it. And excuse me if it sounds really naive, because it's very new for me. I was looking at this photo, and imagine this is me, okay? And this is idea, and here's IPO. I'm somewhere here, and just past the idea. I have a prototype. My partner had an idea. I built a prototype, and then we kind of went down like these ties here, and we are kind of stuck because we couldn't. We pitched a few times. We talked to a few people, not to VCs, obviously. But we were kind of confused. So if it were some technical question, obviously I would Google it or go to Quora or something. But I don't know how to find seed investors. They are not, well, we couldn't find it in AngelList and in a few other, Y Combinator and so on and so on. So my question is, what is the best way? Is it just searching like personal relations? Is there any electronic resource? Or is it just like, this way? And another question is, do you do like mentoring, so to say? Do you mentor people?
I'll take it. I think the short answer to your question is, I think you need to kind of also be willing to, you have to finally ultimately convince someone that your idea is worth taking to other people, right? So to get a referral, you have to convince that person that it's worth making the referral in the first place. And if you're unable to convince anybody, I would actually say you should actually go back and look at what you're doing and say, is this actually what I think it is? Or should I modify it so it actually gets more traction, it gets farther? And so I think the whole construct of being somewhat pig-headed towards success rather than the idea, I think is quite helpful in pivoting to success.
What I think is that it's like we couldn't find the right people. So and that's hence my question: how do I find them? The ones that are interested in, let's say, environmental, related issues.
The only thing I can add is, and this is tough, man, probably the toughest thing. We're kind of believers in Mother Nature, that you can't. I guess there were a couple singing groups in the 60s and 70s where their promoters kind of picked random people, and I think the Monkees, that's sort of my generation. They kind of pulled them together, or they made them. We're not believers in that sort of approach. It's like you all have to find your own teams. You have to find people you work best. Then you come to us and we go, great. Oh, you need a VP of marketing, maybe we know someone. You need a CTO, maybe we know someone. But for the most part, your team is full. And so my comment to you would be, in addition to the short comment about, are you sure you got the right idea? In addition to that, if there isn't anybody on your team that's kind of maybe the extrovert or the finance person, or that sometimes in early stage you don't need a finance person. Everybody's got to be a utility infielder. Everybody's got to do everything. But if you're struggling with the pitch, it's not terrible to find somebody early on to be part of the team that's better at that than maybe you are. So that's all I would say is, if you think you got everything else lined up and you're really struggling, it could be that you're just having a hard time doing the networking and telling the story. But our opinion is you have to let Mother Nature take its course, and you have to find those people, and that's hard to do.
Okay, thank you very much. I thought so too. Thank you.
All right, let's give it up for our panel. Let's hear it for our great moderator, Chris Forrester. Let's hear it for Sherman and Sterling and all our sponsors. Let's hear it for our video team. Let's hear it for our audience. Let's hear it for me. So our panel will stick around till 9 o'clock as a courtesy to our hosts. We'd like to leave the building by 9. However, if we hang out in the lobby, we can all go down to Round Table Pizza, which is about 1 block away, 1225 El Camino, and they close at 11 to keep the conversation going. The video will be available on our YouTube channel in about a month, youtube.com/IdeaIPO. So thanks for coming. See you next time.